Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
All right, guys, welcome back to the show. I am your host, Brett McCollum, and I'm here today with Bernard Reisz. Today, we're going to be talking about CPA strategies. Before we do, guys, at Investor Fuel, we help real estate investors, service providers, and real estate entrepreneurs to 5X their businesses to allow them to build the businesses they've always wanted and live the lives they've always dreamed of. Without further ado, Bernard, how are you, man?
Doing awesome. Great to be here on the Investor Fuel show, and looking forward to an episode that hopefully will pour a lot of fuel on the investor fire.
I love that. That's great. Man, I couldn't have done a better intro myself. That was perfect, Bernard. Good job. All right. Hey, it was good catching up with you a little bit, getting to know you, your business a little bit. Can you do me a favor, kind of rewind us back a little bit, take us, on a journey here, catch us up to speed. Who is Bernard?
Let's do it. I think at the, kind of break it down and take it down to like most granular level, more than anything, I view myself as really a scholar. It's a big term, but it means I really enjoy knowledge and research almost for its own sake.
Yeah.
And then you fast forward when I kind of became initially, got my accounting degree and was in, doing audits of forensic auditing and tax work and advisory, any particular topic that I came across,
right.
I used to kind of take a super deep dive into these niches as they arose. And I did honestly see most of the folks around me were not doing that. Kind of stay to what the core of what you expected somebody in the field to do. So kind of took these things, these different niches, as developed the expertise,
right,
and turned them into their own business. And here we are today, where we kind of deliver what we call the tax trifecta for real estate investors.
Cool.
Which is 1031 exchanges, cost segregation, and self-directed retirement accounts. Each one has its place. Sometimes they can all work in tandem, and some investors will use 1, 2, or 3 of them. They have their ways of working together to help investors juice their returns and keep more money in their pockets, more cash flow for themselves, and away from Uncle Sam.
Love that. That's very cool. Nobody in the history of me recording has said to me, I'm a scholar. That is so cool, by the way. So congratulations. You were the first. I love that, by the way. And I think that's, for what it's worth, we are different people. I think you might find here very shortly, Brett is not a scholar. I kid. Tell me, growing up, is that something you've always kind of learning and growth that way? Has that always been a passion of yours?
Oh, absolutely. As a kid, I would be really frank, people thought I read the encyclopedia as a hobby. But, there was always that pursuit of knowledge and kind of wanting to know everything about everything, and to be really
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Thorough about it and really try to understand it and kind of get down to the fundamentals. So it's not just about gathering fragments of knowledge. It's about really understanding it and integrating them and working with them and seeing, hey, what can we actually do with this? Sure. And in a way, tax law, there's certain things about tax law that I love and certain things tax law that I'm not so enamored with. So I'll tell you first what I don't love about tax law. What I don't love about tax law is that it is a totally and completely like human construct. Like if I were to talk about like, hey, what do I want to nerd out about? In a way, it's like, hey, physics, biology, medicine, like those are real integral parts of reality.
Yeah.
All right. If you're, a person of faith, right? That's almost like touching the divine, right? If you're getting involved with that. In contrast, like, hey, if we got rid of taxes, I think everybody would celebrate. Like, would it be great if we didn't have taxes? On the other hand, tax law is like, what's amazing about it is like pure abstraction. So if somebody is like, loves mind exercises, just loves using their brain and working with conceptual things, tax is a complete abstraction. It's an incredible mental exercise to work with thousands of sections of code and regulations and case law. So it's very, very rewarding and gratifying mental exercise.
Okay, because that was going to be part of and I think I see it now, like how does a person that's, a scholar and somebody that's going, like, how do you land in that space? And that makes so much sense now. I wanted to back up a little bit and highlight something you said though. Knowledge is, you like consuming knowledge is really good, but how do I apply that knowledge? That's wisdom at that point, right?
Oh, and yes. So applied knowledge.
There's a difference,
There's like the pure science and then there's the applied science.
Yeah. And I think it's the same thing. It's the idea that common sense isn't so common, meaning that you can know things all you want, but if you can't put it into practice, it doesn't matter. Like my daughter, she's 8. Okay. She is wonderful, like on a different, like wonderfully smart. And I'm like, wow, that I don't know. And I know she probably got it more from my wife, but I'm like, this girl is like marketably smarter than the average bear kind of thing. And, but then like, she's so flighty, like you are. So we're working on teaching her how to apply the knowledge that's come in, and she's 8, of course,
Yeah, it comes with time. I think it's like kind of let them spread their wings, let them find themselves before like the practical application in a way is like the enemy of the abstract. It forces you to kind of land on the ground and it's got to happen eventually. But I think like, having a lot of time in just that purely conceptual phase, letting the mind develop and expand, unhindered, that's a beautiful thing. So I would say, yeah, definitely. It'll probably come with time. And the realities of life in a way.
Unfortunately too,
dictate.
Right? Yeah.
It forces it.
It's both good and bad in some ways, like kids are so great to watch because they haven't been told they can't. And I think it's really powerful to see that. But back up to this though, and I had no idea the way you just kind of explored this idea of using tax code and using that as an abstract Because in my head, it's very just black and white. This is what it is.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
You know, and the way you said that, I'm like, man, maybe I've been not just this, but maybe other things I've looked at also from that just black and white perspective, like it's yes or it's no. When did you first jump into, like, what kind of dipped the toe in the water for, from, an accounting perspective, from numbers? Like, has it always been about numbers? Has it always, like, what got you really ultimately interested in taxes?
So it's really not numbers. Taxes really isn't numbers. And even true accounting, I would say, is not numbers. I find it very interesting. People are like, oh, you're a numbers guy. I am actually innumerate, I would say. I am not, right? Accounting has many different components to it, and you'll find different accountants do different things. So like real accounting has nothing to do with taxes. It's really about categorizing and characterizing transactions. It's like taking, hey, what a business did, looking at all their numbers,
right,
and defining each transaction. Now on some businesses, it's very straightforward. On larger, more complex businesses, it can be very difficult. So that's why we have something called general, there's GAAP. Accounting principles that are used, and GAAP has its own rules, how to classify transactions. But typically, that's to produce financial statements. So that's what accounting really is. It's about looking at a transaction and understanding it and saying, how do we classify this? The numbers, the calculator will do that. Then, taxes has its kind of its own set of rules, its own set of accounting rules, how to classify transactions, what the tax impact is of transactions. Now, for me, the first real deep dive was actually something called captive insurance.
Okay.
And I remember working with the insurance, various insurance regulators. So it has an insurance component to it, and it has a massive tax component to it. That was kind of like my first real deep dive, working through the employee benefit side, working through the property casualty side, and working through the various IRS rulings, case law, code and regulations on that topic.
Right.
And that goes back, I'd say, about, 11, 12 years ago.
Okay.
And that was like a real niche project where it was done for, a particular client. And then all of a sudden you find yourself, you're like, hey, I'm now the master of this. And like every insurance regulator wants to know, like, how long have you been doing this? Which law school did you go to? And that was where I realized, I really like taking this route, going the deep dive. And from there, kind of one thing led to the next, and niching down into these specific tax services.
Dude, that's incredible. All right, let's talk about those a little bit. You mentioned the trifecta earlier. Can we kind of start at, the top and work our way through each of those, kind of define it a little bit, because some of our audience may, we've all heard of different things, but maybe kind of give a loose definition for each one.
Certainly. So, one of the most wonderful things about real estate investing is that you get to take advantage of some of the fabulous sections of the tax code that keep more money in your pocket, allow you to generate economic income and an economic gain without reporting any income to the IRS. So from a strict real estate perspective, I think like the first one worth talking about is cost segregation. Cost segregation gives you allows you to take the depreciation deductions that your property would produce.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Upfront. So typically your property will give you depreciation deductions over 27.5 or 39 years. Through a cost seg study, you get to take a very, very large chunk of that in year one, creating very substantial tax losses that can either offset any other income that you've got, and to the extent you've got extra losses, be carried forward to subsequent years. So when somebody buys a property, typically the first tax service they're going to be getting is a cost segregation study to create and give them that big tax loss. Again, the beauty of it is it's not a financial loss. It's only a loss for tax purposes. So before we move on, anything I should add to that? Obviously, each one of these topics is very deep and very broad. Any questions about the little synopsis?
Yeah, I think so. Great overview on that. The question, I guess, would be, you take it's 27.5, let's call it 27.5 on this one, and you take most of it up front. How much up front? And then what happens in years like 5, 6, or 7? If you take them all up front, do you have to then pay them back later, kind of thing?
Great question. And the short answer is that there are very few freebies. There are some freebies in the tax code, but almost everything that you kind of take, at least theoretically, you're supposed to pay back eventually. But there are ways to manipulate that. But at least to answer the question, when you buy a property, and just use round numbers. You buy a property for $1 million. Sell it the next day for $1 million. You have no taxable gain because you bought it for $1 million. You sold it for $1 million. Suppose you bought it for $1 million. You sell it 27.5 years later for $1 million. What's your taxable gain going to be? $1 million. Now, why is that? You bought for $1 million. You sold for $1 million. Your taxable gain is going to be $1 million. And again, I'm oversimplifying. Is because over the 27.5 years, you fully depreciated the property, which means each year you took a tax deduction equal to a portion of that $1 million purchase price.
Yeah.
So by the time 27.5 years later, your basis in the property, what we call your adjusted basis, is down to zero because you took deductions for the full purchase price. So if you sell it 27 years later, your gain is, you sold it for $1 million and your remaining basis is zero, you have $1 million gain. That's how it would work. And with cost segregation, right, you reduce your basis way faster, right? So after year one, you've already taken off a huge amount of basis because you took a deduction. You took that depreciation in an accelerated schedule. So technically when you would sell it, you would have to recapture it. But that's where 1031 exchange comes in. So it's like they work hand in hand. A 1031 exchange will defer most of your recapture. So if you do any type of capital gain, on the way in, do a cost segregation. On the way out, do a 1031 exchange. So they kind of work together. So you get to kind of have your cake and eat it too. Cost seg on the way in, 1031 exchange on the way out.
Makes a lot of sense. Yeah. And then, so I guess since we're on the subject of 1031, same thing, 50,000 foot view of it, and then we can ask some nuance if we need to.
Certainly. So this is in the tax code since 1921. The concept of exchanging property. If you do an exchange, no gain or loss is recognized when an exchange happens. So way back then, what that meant was, hey, I had a horse, you had a horse, we swapped horses. Even if my basis of my horse was $20, when I got it, a $100 horse in exchange for that, no gain is recognized.
Yeah.
The logic behind that is, number one, there's continuity of investment, kind of viewing it as you never exited. You really stayed in the deal, so to speak. Secondly, you don't have any cash, right? And it isn't really right for Congress to try to make you pay taxes when the transaction didn't give you any cash, right? You can't. The IRS is not going to take a horse, and they're not going to take half a horse, right? So you have no cash after you swap horses. Same with real estate. So if I've got a piece of real estate that I bought for $1 million, and I rather than selling it for $2 million in cash, I swapped it for a $2 million property, no taxable gain would be realized because I swapped my land for somebody else's land.
Right.
Now, very seldom does an exchange actually happen that way. So that's why you have what's called a 1031 qualified intermediary to enable what's known as a deferred exchange. Because how often does it happen that I want to swap, John wants to swap with Jane, right? So typically, John is selling his property to Jane, but the next property that he's going to get is not coming from Jane.
Correct.
It's coming from Jill. So how do we make that happen? And typically they're not happening on the same day.
Right.
So that's why we have 1031 qualified intermediary service that allows you to have an exchange transaction that involves multiple parties and takes place over an extended period and still be treated as an exchange for tax purposes. You satisfy those rules for the exchange. You sold the property within 6 months. You bought another property. No taxes recognized. No gain recognized. You got your new property. Uncle Sam is out in the cold.
And to clarify, these are like kind and or bigger than the property that they have to be like the other property or better. Is that correct?
So two key words there. We call them like kind exchanges, which means the properties have to be like kind to each other. But for the most part, even though like kind is so key to 1031 exchanges, it's almost irrelevant now. Previously, you can do an exchange on personal property. I mean, you could exchange horses, boats,
right,
baseball teams. So we had to know what's like kind, right? Can I swap a plane for a baseball team? No, that's not like kind. But since TCJA, like kind exchanges are limited to real estate only. And just about all real estate is like kind to all real estate. There's some question marks, some questions, but in 98%
trade up from residential to commercial.
Yeah, exactly. So basically, in the world of real estate, it's almost a moot point. So everything is like kind. Now, in terms of going equal to or up in value, that's not a technical requirement for a valid exchange. It is a requirement if you don't want to pay any taxes. So you can actually buy less. And you'll have to pay some taxes. So there's something called a partial exchange, which means, hey, I sold a property and I'm going to oversimplify. I sold a property for $1 million. All in my sales, I sold it, after I netted, sale price $1 million. Let's say selling cost is $950. So let's say there's no debt. So I ended up selling, sold for $950, right? $1 million sales price minus $50K of selling expenses. So I have a $950 sale. My replacement property is, $850. So, after we adjust for purchase price and closing costs, right, it adds up to $850. So we have that $100,000 delta.
Right.
That $100,000 may be taxable, but it's still a valid exchange, right? It doesn't disqualify the exchange. It just means the exchange may be partially taxable.
Very good. Yeah, that makes perfect sense. Yeah, I've kind of had that question in my head, like going from residential to commercial. Can you go trade back commercial back to residential? There's a lot of questions in my head with, what exactly is the qualifier or not, that sort of thing.
And it's very broad. It's more like it gets trickier when we start dealing with leases, which are real estate,
Yeah.
with intangible property rights. So a lot of things like real estate intangibles are also real property for 1031 exchange purposes.
Yeah.
Mineral rights, air rights, development rights.
Interesting. Yeah.
Options, contracts. So that's where it gets to be more applicable. Are those like kind to fee ownership in a property? But in the majority of transactions, you can buy a duplex, you can be good residential to commercial to agricultural to industrial. It's all like kind.
Very cool. Very good. And close us out. The third leg of the trifecta.
Oh yeah, so self-directed retirement accounts, while they're not strictly a real estate tool, their most popular application is definitely going to, has always been real estate. Other things come and go, crypto, various stuff, have their day in the sun, but real estate is always there, right? Real estate's nice, dependable. And so we have real estate investors using them in different components and capacities. So there obviously can be used to buy property. They could be used to, get into a syndication. So you can do just, be used for private lending, or hard money lending. So we have a lot of our investors coming for a couple different angles. Some of them, they get their start in real estate by leveraging their retirement account assets.
Yeah.
So they're going to come, they're like, hey, I want to do real estate. I'm going to put some money into somebody else's deal. Or I'm going to be a lender. And where am I going to get the funds? I'll get that. I'm going to create a self-directed retirement account and use those funds to lend, or they'll use that, for their equity and get a non-recourse loan to fund it and buy a property in there. And then we also have very experienced investors that are using their self-directed retirement accounts as well. And again, typically they're generating tax-free real estate returns using those retirement accounts. And again, it's versatile and it depends on the profile. So if we have a guy that's been doing real estate basically since he got out of college, or he skipped college and he always went straight to real estate, those guys typically don't develop a big nest egg inside of retirement accounts. They're more going to leverage them as, to get funds into their deals, right? Now, fast forward 10 years, they've got a lot of experience. They've got a lot of years under their belt. They're going to bring in outside money. They're going to leverage retirement accounts to bring investors in. Our real estate agents or developers or equity raisers, capital raisers that are generating ordinary income, we'll find them setting up their own qualified retirement plan, solo 401k, so you put money in there. So if you're getting a commission, right, you can set up your own retirement account, put in, 70 to 140k, depending on the configuration, take a tax deduction for all that, and then put it right into real estate. So typically people are wary of retirement accounts, real estate people, because they're like, hey, there's a trade-off here. Yeah, I can get tax deductions putting money in there, but then I can't do with it what I want to. So these let them kind of get the tax deduction and then deploy the money in real estate. So I could let them have their cake and eat it too.
Yeah, that makes sense. Is there any kind of risk profile that people should be aware of before they start deploying on on their solo, IRA stuff?
There's always a lot of unknowns, and I think that's a fantastic question because a lot of these things people get excited. Wow, sure. I heard I could put this into real estate.
Yep.
And that's absolutely true. But there's always anything tax code related. There's stuff that you got to be aware of. The IRS never makes it, easy. You've got to know the rules, and here and there are a couple of gotchas. And that's what we try to offer, is try to kind of help people see those blind spots. And if we identify those blind spots, rather than saying, hey, we're not your accountant, we're not signing your tax return, so just look the other way, and hey, if something goes wrong, that's on you, to bring that to people's attention. The most common items that we're looking at is unknown, prohibited transactions. So prohibited transactions can disqualify a retirement account or create substantial tax liability. Most people will be somewhat familiar with them if they get involved in this space.
Right.
But there are some gotchas to watch out for. And then there's also, in some scenarios, potential for tax liability, even within a retirement account, that people should be aware of and know how to navigate. And it's something called UBIT, unrelated business taxable income. Mm-hmm. So all in all, a very, very powerful tool. But if somebody's not given the information that they need, they can potentially make costly mistakes.
Sure. Okay, kind of a last kind of wrapping up question here for us. All three of these, you're on the trifecta, I see working they work together in some way, shape, or form, right? Somebody's, just getting into the real estate investing space, or maybe they've been in for a couple of years, they've made a little bit of money, they're not, they're kind of in that, they haven't really gone full tilt, like I've done 150, 200, 500 deals, like they're just really starting this. What are some great starting positions for them inside of something like what you offer, from a tax strategy standpoint? Like because that's a lot of times, I think a lot of the investor world, we don't know what we don't know. So sometimes people are hearing these things for the first time and they're like not sure what best practices, starting positions, what would you suggest?
Yeah. So some of these things, and let's kind of break it down. A cost segregation study, in most scenarios, in many scenarios, is going to be a no-brainer. The key thing that they've got to know, and really the only way to have the full tax picture, is by bringing their tax account into the picture. I've got one of the most popular blog posts that I've written, highlights why a cost segregation study only tells a small part of the story.
Right.
So, somebody brings a property to us, we can say, hey, we analyze it and we think it'll, you can generate X amount of deductions if we do a study. And, actually, no, you signed up, here's a study. All right, you signed up, we do actually do the study, here's your final report, here's the depreciation deductions that you should be getting. They can go to their tax account and say, here's a study, and he'll say, you know what, you're not getting any benefit from this.
Sure.
And you know why? It might be because they didn't materially participate. It might be because they're not a real estate professional. It might be because they don't have other taxable income that year that they need to offset. So I think we make it easy. When it comes to cost segregation study, we always provide a free preliminary analysis. And then we tell people, hey, we're very happy to communicate with your accountant because we don't want to sell this to you. And then come tax time, your accountant will tell you this doesn't actually benefit you. And at that point, hey, it's no backsies, right? We want to communicate up front. And we're always ready to be a resource to the accountant to say, sometimes an accountant says, nah, this never works. And we're like, nah, we can point them out to certain resources or tax strategies that can make it work, right? So no accountant is an expert in everything. Nobody knows everything about everything. So by putting our heads together, sometimes we find an accountant is under the impression that their client cannot benefit from something. And by communicating with the accountant, we show them and demonstrate, here's how they can potentially benefit from this. So I think it's easy to get started. If you bought a property, you just need to speak to a cost seg company and get your accountant in on the discussion. If it'll be a little bit of a shill for reshore, right? We think nobody bridges the gap between the cost seg study and your tax return and your tax accountant. Right. Better than we can, right? I'm a CPA. we have an incredible amount of resources about tax strategy, not just about how to do a cost seg study, but actually how this can or can't work on somebody's tax return.
Yeah.
So I think that's like a no-brainer. Bought a property, reach out to a company that provides cost seg studies, get the preliminary analysis, and before pulling a trigger, get an understanding of how to actually impact your tax return. And all that is at zero risk, right? It's just a conversation with your accountant, conversation with the cost seg company, no risk, and it can be worth tens of thousands to hundreds of thousands of dollars if it does make sense for you. That's on the cost seg side.
Yeah. Man, I want people to be able to reach out and connect with you and learn this for themselves, because there's just so much we don't know, right? We're just flying a million miles an hour, just trying to get to the next deal, that sort of thing, and oftentimes we're leaving how much money on the table by not having the right people in our corner, as a part of the broader part of our team, so to speak, right? So if people do want to connect with you, Bernard, in some way, and what's the best way for that to happen?
Yeah, the best way is email to success@reshorefinancial.com. So that's success, exactly the way it's spelled, at RESURE financial.com. I'm going to guess it's going to make it somewhere in the show notes.
Yes, we'll make sure it goes in the show notes for sure.
And if they visit our website, we've got buttons there where you can click to schedule a quick call to discuss things. If you've got a specific property in mind for cost segregation, cost seg webpage lets you type in basic info. It goes into our client portal, lets you schedule a Zoom meeting to discuss it. Same for our 1031 exchange webpage. Allows you to schedule a 1031 specific discussion call to discuss your transaction. So it's really easy to schedule those calls and see, whether or not something makes sense, whether a cost segregation study, 1031 exchange, or self-directed retirement account can make sense.
Love that. Yeah, and we'll make sure it gets into the show notes for you guys as well. But man, Bernard, what a wealth of information coming from you, man. I genuinely appreciate you sharing your knowledge with us today. And I know we were just literally scratching the surface. So thank you so much for being a part of that and doing that with us.
Brett, my pleasure. I love sharing the knowledge, love, interacting with the audience, so to speak. Yeah. I look forward to getting some feedback. And thank you so much for hosting me.
Oh, you're the best, man. Appreciate that. Well, guys, to you as well. Thank you so much for spending your time and hanging out with us. Hope you got a lot of value today, and we'll see each of you on the next episode. Take care, everybody.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.